I guess, how do you put the run we've seen, especially in things like semis, into some context? What's driving it?
Yeah, it's amazing. So you said the NASDAQ up about 28%, and driven a lot by some of these bigger cap companies. Apple's up over 60%, Microsoft's up over 40%, Facebook's up over 40%. But interestingly enough, to your point, semis has been the subsector that's up 58% or so, driving a lot of the growth. The other subsectors are up about 40%, give or take. So it's been strong across the board, with internet sort of trailing, only up about 11% or so. When you try and put it in context, we're trying to think about what did we learn in the most recent quarter's earnings, as well as what did we learn throughout the year. So if you just take a look at the Q3 earnings, what did we see? We saw a dichotomy there. There was a couple of names that really got beat up, right? Whether it be changes in their business models or problems they're having, like a Farfetch or a Grubhub. But you also saw some companies run into some obstacles you didn't see coming, like an Expedia or a TripAdvisor got hit by a Google algorithm change, right? Ironically, some of the names that have been most beaten up have done some of the best. So someone like Snapchat's up over 150% so far this year. So we learned a lot of different things there, particularly what investors are focusing on, right? So they're focusing on a couple things. One is the core unit economics. Are you making money in what you do? And if so, what is that ROI? Number two is how visible is your revenue looking forward? How reliable is the forecast we have? And number three is that path to profitability, which ultimately the returns that we're having on this money. So I think that's one of the things we learned not only just during the quarter, but that we've learned also throughout the entire year. And if you're not checking those boxes, you've seen some companies punished during the year that weren't able to answer those types of questions.
So we are retrenching to the giants? Is it that simple?
I don't think it's that simple, because you've also had some smaller guys that have also ripped. Even something like a Roku has done tremendous, right? So you've had some nice movement there. I think the interesting part is when you start breaking apart a little bit more, it's interesting about the tech IPOs and what happened there and what we're seeing. So tech IPOs, as you know, this year to date, are up about 9% or so, right? However, for the retail investor, after day one of trading, really down about 20%, right? So that 9%, when you think about it, how do you break that apart? Well, for companies that have these more recurring revenues, the SaaS type nature companies, those are actually up like 40% or so. And the ones that aren't of that nature are actually down about 20%. Or even the conviction point too. For stocks that pop more than 40%, they're up 30% this year versus ones that didn't pop that much are down about 10%. So it's interesting to pull that layer back a little bit. And particularly when you contrast how has growth stocks done versus the tech IPOs. So that 9%, that same exact period, growth stocks have only grown about 2%. So you still had a 7% incremental alpha there for investors to chase.
I want to hear you talking about checking the boxes and talking about IPOs and what we've seen in terms of performance this year. Has it rippled back to the private market? Do you think there's been any kind of reckoning in terms of valuations we've seen there?
It's a great question. And I think the intuitive guess is absolutely there's a disconnect between private market valuations and public market valuations. However, if you look at the data, if you pull the IPO class that just came in 2019, 75% of them today, even with pullbacks, their enterprise value is greater, in some cases a lot greater, than the last private round they did. Now, when you think about that, it sort of makes sense to a degree, because the private rounds were done more than a year ago, in some cases 2 years ago or so. So there's been a little bit of time value of money there. And I think one of the lessons we're learning is that private investors are taking a longer term horizon when they make their investments versus what we're seeing in the public side.
Bob, if you thought you were clever a year or more ago and sold off Facebook, Amazon, maybe even Google on antitrust concerns, regulatory concerns, right now you're not feeling so smart. What's the market telling us about that worst case scenario around these stocks? Is it time to put that behind us, or is this just exuberance?
Yeah, it's a great question, because Google, as you know, is up 25% this year. Facebook, as I mentioned, is up over 40%. And I think what you're seeing there is the reason why so many of the active investors are actually trailing their benchmarks and looking for that incremental alpha and hoping to find it in the tech portfolios. But I think you're right, John. I think in some cases investors maybe outsmarted themselves versus what was already baked in for the expectations.
Well, we had obviously huge policy risk, we thought.
Absolutely.
Right? We thought the semi-cycle was not going to go anywhere because of cars.
Right.
What happened to those two narratives?
Yeah, I think on the political risk, it's still there. But I think what investors are realizing is it probably takes a longer time to play out. There's probably not something that's going to happen here. And it's great to make grandiose statements by a politician to sit there and say, we're going to break up this company or that company. But in reality, in practicality, it's very difficult to do. And even if it were to happen, it would take quite some time.
So today, BAML comes out and says, basically ring the register, take tech to market weight. We think the trade war could escalate into a tech war after the 2020 election.
Yeah. So trade war aside, we're actually cautiously optimistic on tech going into 2020, right? And as you know, there's a nice backlog of IPOs that are coming, particularly in the first half. When you think about the IPO market next year, it's important to realize I think the market sort of shuts down around July, give or take, because of the election coming in November. There's going to be too much uncertainty, particularly depending on who the candidates are at that time, right? So there's a lot of risk around the election there. So look for the front half of 2020 to be sort of more backloaded with IPOs. And the last thing I'd point out there is the point I made a minute ago is that active investors are still just trailing benchmark, and they're looking for those incremental alphas, right? And so they can get some of that in the tech market in the first half of the year. They'll look to try and make it up that way.